Okay, can you see there? There's your consumable stores on hand. That is an asset for the business, and that we can only close off as 1,400. There will be a balance of 1,400 tomorrow morning in the books. There will be a balance of 1,400, and that is one of your temporary accounts. And remember, your temporary accounts, we are going to do a reversal transaction on your temporary accounts. Please, whatever you see here is not used yet. That's why you can count it. Assets, owners' equity and liabilities plus 1,400 rand. For the assets, because your consumable stores on hand becomes more. Minus 400 rand, because your stationery becomes less. Sorry, plus, remember, I'm going to quickly put it there for you. If this is your owner's equity, owner's equity, you've got 3 there, and you've got 4 there. This is capital minus plus, that makes your owner's equity more. This is sales minus plus, that makes your owner's equity more if there's more sales. And this is income. More income, more owner's equity. On this side, we've got drawings. It's a minus plus, that makes your owner's equity less. Cost of sales is a plus minus. More cost of sales makes your owner's equity less. There we've got the expenses. And then we've got debtors, allowances. The moment that you've got more expenses, then your owner's equity becomes less. But the moment that you've got less expenses, then your owner's equity is going to become more because of less expenses. And that's what we're busy doing at the moment. We haven't got less stationery because we sent back some stationery. We haven't got less packing material because we sent back. No, we've got less stationery and less packing material because we don't use the stationery and the packing material that we already bought. So plus 1,000 rand there, because your packing material also become less. And then remember, there's a big equal sign there. And there's a plus there. This equal sign can help you to see that a plus on this side equals to a plus on that side. That was the third one there, consumable stores on hand. Depreciation on cost price. This is an expense for the business. Value of vehicles and equipment decrease because of wear and tear. On the last day of the year, we've got equipment worth of 45,000 rand. We've got accumulated depreciation in equipment to the value of 17,200 rand. And we write off depreciation on equipment at 12% per annum on the cost. Very important to see that it's on the cost. So the first thing that we are going to do, equipment is an asset, 2019. February 28, balance brought down. So we've got equipment to the value of 45,000 rand. Accumulated depreciation on equipment, 2019. February 28, the balance is on the credit side. 17,200. What is the meaning of this? The first thing is that this plus on this side show you that this accumulated depreciation is a negative asset. What is a negative asset? A negative asset is things that you are going to subtract from your asset, and it's going to make your asset less. That's a negative asset. We only have two, of which accumulated depreciation on equipment is one. The meaning of that 17,200 is that up till now, the end of basically the first day of this financial year, we already wrote off depreciation on our equipment worth of 17,200. So at the moment, 45,000 minus 17,200, this is what our equipment are worth at the moment in our books. Okay? 27,800, because we took the cost price and we subtract the accumulated depreciation. Now they ask us to work out depreciation at 12% on cost. So you only take the 12%, you times it by the cost of 45,000 Rand, and you work it out for the whole year. So you've got your 45,000 there, 45,000 times the 12%, and there we've got 5,400 Rand is the depreciation for this year. 5,400 is the depreciation for this year. What are we going to do with this? We are going to debit depreciation, your expense. We are going to debit depreciation. There's your depreciation. It's a plus minus because it's an expense for the business. On the last day of the year, February 28, accumulated depreciation on equipment. I know it's a long story, but you must write it out. 5,400 Rand. 5,400 Rand. This is a new expense. This is an expense for the business. What expense is this? Because of wear and tear. Because we use our equipment, and it's not new anymore. There's wear and tear. That's why there's depreciation. Now you go to the credit side of accumulated depreciation, and you put there depreciation of 5,400 Rand, and that gives you a total by the end of the day, or the end of the year, of 22,600. $22,600, and that is your accumulated depreciation. It's a B account. This is a B account. This is a B account. This is a B account. Negative asset. By the end of the day, in note number 3 in our balance sheet, we are going to subtract the accumulated depreciation from the equipment. So it's a negative asset, and you work out your depreciation on the cost price. This is the cost price. You work it out on the cost price. It gives you 5,400. So at the end of the year, your equipment is 45,000 minus 22,600. So it's worth 22,400 Rand at the end of the year. What are we going to do with depreciation? What are we going to do with our depreciation account? We are going to close it off to profit and loss. On the last day of the year, 2019, February 28, profit and loss. Remember, everything that we close off to profit and loss is part of closing transfers. Closing transfers, and we are done. So we've got a new expense there. Depreciation 5,400 Rand. What happens with your assets? Minus 5,400. Remember why? Because the accumulated depreciation on equipment which is a negative asset, become more. So the more you depreciate your equipment, the less the value become. On this side, we've got minus 5,400 Rand because depreciation becomes more. Depreciation is an expense. The more expenses you've got, the less owner's equity we've got. Okay, that was depreciation on cost. That's the easy one. And then not difficult, only a little bit more tricky, is the depreciation on the diminished balance, on the diminishing balance.